3, 2, and 1. The weather rally continued in the grains on Thursday. Garrett Toay with AgTraderTalk joining us. And let's talk about December corn futures. We got above some key moving average and resistance areas with a push on the weather. How much higher do you think we can go here?
Well, we're starting to get into some levels. The daily high in these corners 575 today, right on the button. We got to some levels where we're starting to see some farmer interest as far as hedging concerned. We were busy with both farmers and elevators today, so we're seeing some hedging opportunities in here. we broke through a long-term trend line off of July of last year, down at the 560, 364 levels, and that opened up this move to 575. And it took about an hour for us to get back to this 575 level. So the next area of interest is this 575, which is a trend line resistance off of those July lows last year. Excuse me, I misspoke. The trend line resistance was off the October highs. But if we get through this 574 area, 584 is a 200-day moving average, and I think that things start to get a little bit tougher between this 575 and $6 levels as farmer selling starts to pick up.
Soybeans also pushed not just by weather, but a strong NOPA crush figure and the big rally in soybean oil, right?
Yeah, it kind of was a perfect storm today. Beans have been beans saw the big sell-off here 4 to 6 weeks ago, and beans kind of have been correcting versus corn over the last week to 10 days as far as the ratios are concerned and the spreads are concerned. Perfect storm today. We had a $2.50 rally in crude. We had a record NOPA crush. We had a surprise draw on soybean oil stocks. Nove beans with their biggest upside day here for life of contract, and we've rallied about $1.15 in the last 5 days. So a substantial rally. Soybeans are going to soybean. That's what beans do. And we got up to the 100-day moving average today. I think resistance builds between here and 13.35. We came within a nickel of $13. So some decent levels here where we're starting to get back into some levels that are profitable to hedge if you haven't done anything yet. But weather market's going to make a tough decision, but it still needs to be stick to your marketing plan.
Yeah, I was going to say these are pricing opportunities, aren't they?
Absolutely. This is a supply-driven rally. Supply-driven rallies are meant to be sold. We still have a bit of demand issue on corn. We don't necessarily have that issue on soybeans, but the Brazilian farmers probably going to benefit the most from the demand side of things between now and October, because they're still $20 to $40 a ton cheaper than U.S. corn on the export market. And even last month's Brazil trade data showed that China's already started to take corn out of Brazil. They took about 100,000 tons of corn out of Brazil this past month.
All right. Thanks for joining us, Garrett Toay with AgTraderTalk. We'll have more Ag Day coming up. Okay. Let's do the longer one. I think we went a little over, but I think I can trim it a little bit. So no worries there. Okay. Here we go in 3, 2. This one is longer, obviously. We've done this one before. 3, 2, and 1. Welcome to Markets Now. I'm Michelle Rook along with Garrett Toay, AgTraderTalk, and mostly higher closes today with the exception of feeder cattle futures. And Garrett, let's start off over in the grains. We're in the pledges of a full-blown weather rally, and let's talk about corn futures. December got above major key moving averages, some technical resistance. How much higher do you think we're going to go here?
Well, I mean, I think we're going to probably try to work our way towards $6. In the past, I wasn't so sure if we were going to get back to $6, considering historical ranges. But we're to the point where we might see transfer of ownership. We saw more farmer movement today. Obviously, the fund short that was remaining is probably covering. Question is in this environment, do the funds really want to get long in here? Time will tell on Friday's Commitment of Traders report. But I think things get a little bit tougher from $5.75 to $6. But this is a weather market; anything is possible. And that is until either we see a pattern change or it starts to actually rain.
Right. And we also had the drought monitor showing 57% of corn acres are in drought. And so that kind of pushed this thing too today, didn't it?
It did. I think it was in corn. It was the corn belt or corn acres. I think it was a 12% spike versus last week, 11% in beans or something like that. Fairly sizable jumps, yes. But it was basically what we were looking at from last month's CPC report that showed the drought expanding across Illinois, Indiana, Ohio. It's fully entrenched those areas. But the market's all tied into weather at this point.
Absolutely. Okay, the beans, though, Garrett, traded more than just weather. In fact, soybean oil has been leading this rally here. We had strong NOPA crush. We had some pretty decent weekly exports. And soybean oil, like I said, has been leading this. And so will that continue?
We're starting to get in some key areas that have been long-term resistance in bean oil. Oil shares rallied nicely, and that's been part of the liquidation that we've seen from this meal long. The meal long is essentially paired half of what its length was. It was just so large relative to historical norms. But even though they've paired about half that length, it's still about the fourth or fifth largest meal long that we have on record. So that's kind of led the drive here on bean oil. We do anticipate, I think most everyone is anticipating increased demand in renewable diesel in the fourth quarter. So we're starting to get into those time frames where we can see that coming into view for soybean oil demand. And obviously, considering the investment in renewable diesel facilities in the fourth quarter, any sort of crop production issue that may impact soybean oil is going to catch the market's notice.
Yeah, but you think soybean oil will run up into good resistance again here at that 200-day moving average? Is that what you said?
Yeah, this front end on the 200-day moving average, we have not been able to trade bean oil above 59 cents, much of all, except with the exception of about 6 weeks back last fall. So that's at 59.20. I think that probably starts to see where this market runs out of steam. But similar to Nova Beans, we've had a nearly 10-cent rally here in a matter of about 2 weeks' time. So the market's on its own little planet.
So what do you think? November beans, do we get back above 13? You think or not?
Man, we came close. We came within a nickel of it today. I do think we do push above 13. We're just strong close today. If we can get through this 100-day moving average at 12.95, you have a trend line resistance and the 200-day moving average up at 13.35. So those are kind of the next areas, along with some consolidation here from 13 to 13 a quarter. So 13 a quarter, 13.35. Those are the magic numbers to put down on your charts.
So we were so bearish about this market just a month ago. So is this a rally that is meant to be sold here, do you think?
We were bearish because we had a demand problem. We still have the same demand problem, but now we have a supply problem. So at some point we balance each other out. Seasonally, you always have the out of 10 years, 8 out of 10 years, we typically peak in June and July, right? So assuming that it does rain, now is the time that you need to be making some sales. Now, at some point, we have issues in Ukraine, we have issues in Argentina. The Brazilian crop is more than offset a lot of that, but these Brazilian supplies are going to get used up if the world end user ever gets nervous. At this point, they aren't. They've been held fairly steadfast. But if the U.S. does in fact have a production problem, you would think that we set some seasonal highs here, June, July, potentially rains, and then we fade into a harvest low, and then we shift to a demand rally, potentially out of harvest into next year.
So what are you telling the guys, though, that are in those drought areas and are hesitant to sell, Garrett, because they're not sure if they're going to get a crop or they're going to have a reduced crop?
Well, I take off my analyst hat and I put on my therapist hat, and I tell them that they have to stick to their programs. I know it's difficult, but there's a way to manage risk on the board, whether it's via puts or via calls. If they're nervous about making sales because they're not sure what they're going to have for production, look at instead of making a cash sale, look at an option or look at a put to put a floor underneath the price, something that they're somewhat non-committal on something where they don't have to produce bushels if they don't have them. But I still think you need to be steadfast in your plan and be doing something. There's always something you do in this market. If you're undersold, buy some puts, or if you're oversold, you buy some calls, protect your upside. That's what's great thing is there's a lot of tools in this market, and using those with crop insurance are best ways to manage risk.
We did manage to follow corn and soybeans here today. What do you think? Are we finally blowing some of those shorts out of that market, especially in Chicago?
It is. I think they're obviously nervous about a row crop issue in the U.S. and there's some dryness issues in Russia as well. But I think that they're seeing what's happening in corn and soybeans. We can still. I don't think fundamentally anything's changed in the wheat market other than this is just risk being reduced from that money market short. I think that. Obviously, when they start rolling, they can compound anything. But I think the $7 area is probably going to capture. We can have a 40-50 cent rally in wheat on short covering any time, and then we tend to consolidate. It's going to be tough to rally wheat because we're just right now in the harvest time period, and I think you're going to see selling on any sort of rallies.
No, that's a really good point. Cattle market, at least live cattle futures, came back pretty decent today. We've got the funds that have kind of been stepping in, defending their longs, but did we just hold support that we needed to? Because it looked like the cash trade was maybe just a little bit weaker.
Cash looks steady to shade weaker. Cattle fats are acting extremely well in the face of the higher corn prices, but that's kind of expected. I mean, the feeders were lower, which traded the higher corn prices, and that is more makes sense. Right. I think the cattle market downside is again on its own little world, trading the cash markets. I think it looked like cattle were going to try to roll over, but I do think that weakness is going to be limited just because cash is firm enough, and I also think you've got an element of hedgers that potentially want to cover. Hedges on weakness on the board.
Some of this weakness has also been unwinding of those cattle hog spreads. Are we about done with that? And is that the reason why hogs have had this good run, or has it been cash led or cash pushed?
Cash is still relatively cheap. I think it's mostly order flow from that unwind. I'd say 90% of it is that. Like we were talking before, there's a ton of cheap pork in the stores on the shelves. Loins, ribs, you name it. They're trying to find demand to displace this Prop 12 shift, and there's a lot of cheap deals on pork. I'm a beef guy, but some of these deals are too cheap to ignore.
That's right. All right. Thanks for joining us, Garrett Toay with AgTraderTalk. That's Markets Now.